We have some moves to tell you about. Jim Lebenthal is the first, and he's bought Lockheed Martin.
Yes.
Why?
Well, for one thing, I have no defense exposure. I sold Boeing back in January. That was my defense exposure. And as I think about things, this is a big picture trade. Unfortunately, the world is going to be involved in kinetic warfare for quite some time. To me, it doesn't matter who the president is. Certainly last weekend's BRICS conference made it clear that there is an alliance of countries that want to upset the Western world order. And that's going to take the form of kinetic warfare, as it has in the Middle East, in Ukraine. We've been spending a lot. We've been expending a lot of missiles. Those are going to need to be replaced. Lockheed Martin replaces those. Lockheed Martin is the producer of the F-35, for which the order book is strong. The things that have held me back from this, Scott, and I've wanted to buy this for quite some time, two things. One, the price of the stock is a little pricey. I have to admit that. But after a while, I've just got to bite the bullet here and get into it. I started with a small position, so I want everybody to know that. If the market comes down and the multiple with it, this will be a source that I add to. But I also want to say that at the most recent earnings report, there were signs of life in the operating margin. People who have followed this industry for the last few years have known the top line is growing, but operating margins within the industry have been terrible, mainly because of supply chain issues. Those are starting to abate. You're starting to see operating margins improve. I think there's more to gain.
Didn't you own, was it Raytheon? What?
A couple of years ago.
You used to own stocks in this space.
I owned Raytheon, and I sold that similarly for Boeing because there were those big issues with one of the engines that they make. Frankly, that was a flat-out mistake. I mean, they got through those issues. Raytheon has been a big player. I thought about getting back into Raytheon, decided on Lockheed Martin, and here we are.
Okay, good stuff.
Raytheon's a good company.
All right, thank you. We got some big oil earnings next week, too. And on that note, Bill Baruch joins us now. He is on the phone because he's made some portfolio moves that play into that space. Good to talk to you. Let's run through these. You sold ConocoPhillips for a loss. Talk to me about that move first and then what you bought.
Yes, we have quite a bit of refinery exposure with Marathon Petroleum, and ConocoPhillips is a refinery-heavy name. What we're looking at there, too, is its seasonality is really ugly until January, typically, margin pressures and refining. So cutting that, taking some of the loss, tax loss harvesting, and then really that's kind of how we're looking at that and moving that cash into SLB. So that name reported earnings last week. I find it at a discount right now. EV to EBITDA is back near the COVID lows. So I think it's a terrific opportunity there. Technology leader, free cash flow juggernaut, terrific balance sheet, and come back to that, just a great opportunity.
Yeah, I mean, it's buying it again because you sold it not that long ago, which is an interesting move. Yeah.
30 days ago, so recycling that tax loss harvesting.
Okay, good stuff. Thanks for calling in. Let's move the ball around. Bryn, so we got Exxon and Chevron coming up next week. You've got Devon, you have Diamondback, you got Energy Transfer. Talk to me about this space.
Yeah, I mean, this is really an interesting space where individual securities within the sector have such huge dispersion of the return. Good example, I own Energy Transfer. It's a pipeline. They're up 18% price only. Forget about the 8% yield you get. Versus Devon on the E&P side is down once again this year, down 13%. So you really have to pick your spots. As I think through going through 2020 into 2025, I'm growing short on Devon as I have before because just the market doesn't like the stock. Versus a Diamondback, the mineral rights space, which we love, Viper Energy has just crushed it this year, up 66%. So I think you really got to pick your spots. And so I think for 2025, I'm going to stick with the pipelines and the mineral right companies and steer away from the more volatile E&P names like a Devon.
Josh, you still have the IEO, the oil and gas ETF?
Yeah, I think there's a potential catch-up trade here. This has been the worst place to be sector-wise in the entire market. And it's now the cheapest sector. It's trading at 10 times price to free cash flow, 12 times earnings. The median return within the S&P energy names is negative 3% year to date. That's versus a 30% return for the S&P. So you have a situation where you're looking at the market, it's run away. You've got huge winners in tech, huge winners all over the place, quite frankly, utilities, REITs, banks. So it's like, well, what can I do now that might make a difference between now and year end? I think some of these companies, maybe not the whole sector, are going to get discovered. 54% of these names are negative over the last 12 months. So you have tons of places to look if you're looking with a value discipline. The problem here is that WTI is at $71. It's up 1% this year. It's just not been anything to get excited about. WTI hasn't been above $80 since July. When that changes, these stocks can start to work. We don't know the timing. We do know you're not taking a lot of risk to put that bet on.
All right.